All right, so I just thought I'd do a little video. I did one earlier today or yesterday, whatever, um, because I've traded books and run risk for decades, and through some pretty interesting times. This is just another one, right? They happen far more regularly than you think. And so I've run risks, when big corporate collapses, whether it's like Enron, WorldCom, you know, some of the Australian corporates back in the 90s, Madoff and his disasters to sovereign defaults like in emerging markets, Argentina, distressed events, in like Venezuela, for example. That's when I was did emerging markets to crazy interest rate events, to things like the disasters like September 11th, Iraq 1, Iraq 2. There's a long list, right? This is just another one. And from running those books, these are to me the my lessons, right? First of all is when you're running risk, you really want to choose your market. You don't want to be in everything. You want to be involved in the ones that right? For example, like at the moment, oil's moving, but if you're not an oil trader, don't dabble, right? You'll likely get burnt, right? You know, if you're a Nasdaq equities day trader, right? Don't get involved in the German bond market. Choose your market. Next one, watch whatever that market is 24/7, because things move very quickly, and that can impact whichever market that you're watching. The other one is when you set core levels, you want to set core levels in the markets that are the closest to what's going on, if you know what I mean, right? So, in Ukraine, right, you're trading, I don't know, like Amazon, right? Don't set a core level in Amazon, but for this one, you really want to be setting core levels in like oil and gold. They're probably the two big ones, and then the S&P, right? In a way, they're the ones, because they all trade 24/7, and they're the ones that if something happens, they're the ones that you'll see the moves in first, right? So the core levels that you set may not necessarily be in the markets that you're trading. They'll be in the ones that are the center of attention. Small positions and big moves is the way to go, right? The best positions I've had always have been small positions that have benefited from big moves, as opposed to big moves where you're just trying to, make a tick here or there. Particularly in those times when there's event risk, you want to cut back on your position size and rely on the moves to do the work for you. Because frankly, the moves can go either way. So you want to cut your positions. Generally, long gold, long bonds, short equity. So when this was like a few weeks ago, right, when it first, came out, I think that Russia was doing this, whatever. The first thing I did was I bought back the bonds and bought back my short gold position. I did have a little bit of a dabble in gold since then, like on a tiny basis, but and also shorted the S&P, right? That's kind of like the safe bet, right? And if everything goes absolutely pear-shaped, long gone, long bonds, long gold, long bonds, short equities is generally the way to go. Like whenever disaster hits, that kind of is what goes on. Long bonds, the caveat of that is choose your country, right? You don't want to be long Russian bonds, right? Next one, technical analysis. It's garbage, right? These moves will happen and they will defy any, trends and, Fibonacci's and stuff like that. They'll just kind of go for it, right? So don't sit there kind of like trying to be smart about picking technical levels. Vladimir Putin does not care about the technicals in your stock. Leverage, beware of leverage. leverage, that's the thing that, and margin calls, that's what will wipe people out. So be very aware if you've got leverage on, and it's not really a time. If you want to be leveraged now, just be really, really careful, because again, it's the big moves that can wipe you out. Another is correlations and spreads can do weird things. Like I remember when September 11th went down, I was trading this options book. It's like kind of 10:30 Australian time at night when the planes hit the towers, right? And the bond market just started rallying. So I was buying bonds, like the bond futures, hand over fist as much as I could. Then the markets were just gapping, choppy up and down, right? But generally up. Buy pretty much any bond futures I could get my hands on, right? And traded it all that night. Had to go into the work, in the wee hours of the morning, because the whole thing had run off my charts. Because back then you didn't have good online access, and everything was going okay. And then as soon as the the Australian swap market opened up, the swap spreads totally blew out, right? Really blew out. So although I've made money on the interest rate risk, the spreads, I gave it all back on the swap spreads, right? So these things, so some markets where you think there's a good correlation and a reliable spread, that can go pear-shaped. That's known as like basis risk, right? So I guess, some example of that, like in this, environment, the spreads, it could be the curve risk, it could be the spreads between Euro 10 years and US 10 years, those kind of spreads that could do weird things. It might be people have this stupid idea, or historically, not historically, the last couple of years, gold and Bitcoin, and that's something that's really been shown up, these past couple of weeks, where Bitcoin is much more aligned. It's just like an extremely volatile equity. It's not a safe haven like gold at all, right? So during these times, some of the correlations and spreads, if you're relying on them, be careful. And that comes back to choosing your market, right? Really choose your market carefully. Another one is looking for liquidation events. That's kind of linked to the leverage here. When things really hit the fan, you tend to see big bearish spikes, basically, like people liquidating assets, whether it's liquidating gold, liquidating bonds, liquidating oil, liquidating their equities. When those things happen, you see them, they generally happen in the cash markets, right? Because it's people that have to liquidate for cash, right? And they've had their margin reports issued overnight and they've got to clean things up. So they do tend to happen like in a cash market rather than in the futures market, those liquidation events. And they're the ones that can really lead to this. Those sitting back and watching, really wait for those compelling trades. A really good recent example of that is when oil recently went to like minus $40. That was WTI. I remember sitting here watching it in the middle of the wee hours, and it went down. It was like negative, right? That was an astonishing liquidation event. I wasn't in oil because, as it wasn't at the time one of the key markets that I was watching, right? But that kind of feeds into that. When you see those big liquidation events, that's the time when you want to get in and pump your bullets. So look, that's the long and the short of it. Trying to be helpful and being serve some kind of education purpose. So during these times, this is kind of the checklist, right? Choose your market carefully, be in the ones that you understand and stick to them, right? Don't try and be a smart ass. Watch it all the time, right? Don't just watch it when you're awake, watch it when you're asleep. How do you do that? Setting your core levels in the primary markets, right? In this case, that really is gold, oil, and probably the S&P futures, right? S&P futures, right? Because it's 24/7. Keep your positions small. Let the moves do the work. Don't try and be a big swinger with big positions. Generally, if you're short gold, right, and you're short bonds and you're long equities, that's that's a pretty risky proposition during events of instability. Go the other way around if you want to. Don't rely on like your smart ass technical analysis, right? You know, it's overrated at the best of time, let's face it. If you got leverage on, be very careful. These are the events where it can wipe you out, right? The correlation spreads can do weird things. If you've got positions on that you think are offsetting, go back to this. Choose your market. Do you really want to be running those spreads at the moment? I don't think you do, right? It's time to get out of spread risk. Liquidation events, that's linked to leverage. You want to be on the right side of these liquidation events. You don't want to be leveraged and caught in the middle of a liquidation event. You want to watch for them, and when you see them, be positioned to act. Sit back and watch for the compelling trades. Look, that's really my words of wisdom. Since running risk and being caught up in events going back to 1987, that's really the first one. I was just out of school, right? So that's my words of wisdom. Hope that's helpful. Have a good one. Okay, ciao.